Welcome to Bees with Rich. I'm Rich, editor of Under the Radar Report. It's great to be back. Well, I know you're seeing fluctuations in your portfolio. God knows I am. But I'm here to give you some valuable perspective and to help show you how to both protect your portfolio, but most importantly, how to grow it. Because as every coach says, offense is the best defense. I'm sure they do anyway. Let's crack it. It's a behemoth. It's a big one. It's multicolored. Could well be 20 standard drinks. Today I'm talking about three things. One, our 14 best small caps to buy. Yep, you heard it right. Two, what's happening with interest rates? Well, they're going up, but let's talk about a bit more detail. Finally, the banks. Who doesn't own them? God, this thing is quite a mountain. Last week we covered 100 plus small caps. And of those, in our research rundown, our much fated research rundown, and we highlighted 21 of those which we deemed quality and dubbed royalty. Just to remind fans of the royalty what that means, it means quality, but what does that quality mean? It means a strong customer base. I mean, every business is as good as its customer base. Solid balance sheet, good operating model, competitive position. If you're in doubt, if you want to know any more, watch last week's. This week, we move ahead. We drill down even further into our 14 best buys. This is where the quality of the stock and the price of the stock are in sync. Just remember the dictum of value: show me a good business, sure, but I'm only interested at the right price. Here's to value. So why do best buys matter? Well, our average return is over 80%, that's why. And because you're on beers, this really is a strong beer, Probably too strong. Fuerte. Because you're on beers, I'll give you an example of one of our current 14 best buys, Trajan Group. TRJ is the code. So this business stands out because it's got an outstanding niche. Not only that, like being highly specialized in precision measurement, it's got a broad global customer base, which it's built up from a solid program of acquisitions. Its largest market being the US. So it's a growing market, and its products are regarded as essential, which certainly helps in the world of business, that's for sure. They have made acquisitions, as I said before, so there is risk. But what I like is that they've delivered on their guidance. So both on prospectus guidance and recent earnings guidance, and more recent earnings guidance, they've come up with the goods. And most important, you're not paying too much for what is clearly a growing business. And that's what you really need, this kind of growth in your portfolio, to fend off the tougher investment conditions that we're seeing with those rising interest rates. Like this week, as anticipated, the US Federal Reserve increased rates 75 basis points. Although that was expected, what I guess was the surprise was just their focus on, we're going to do what it takes. Jay Retherill really is channeling his inner Paul Volcker and saying, we've got to crush inflation. And people, now are estimating rates will go up to 4.6% from the current levels of 3 to 3.25%, which is a huge increase. Like this time last year, they were like 0.1% or something, or nothing. So we're talking big percentage increases. And this is inevitably putting pressure on equities. I mean, that's just a factor, basically, of mathematics. As the discount rate rises, the prices decrease. But growth is a key area for protection. as we've said, with Trajan, with some of the other great small caps we're offering. Another is buying companies that can pass on those price increases because you've got an element of inflation protection there. And that's where blue chips come in. So basically this week's blue chip report, I think I need to go back onto the Forte. This week's blue chip report focuses on the banks. And I urge you to read it. We rank them, from 1 to 4, and including Macquarie Bank actually. So from 1 to 5 in valuation terms and in preference. But overall, they're still delivering a 5.5% running dividend yield. So that's one area, and that's fully franked. So that's one area that we like. But what I think is most important with the banks at the moment is a transformational shift that harks back to what I was just talking about before, which is that unprecedented, it's not unprecedented, but it hasn't happened for a long time, this upward movement in or tightening of monetary policy. That basically for banks means that they're getting that interest income. So that boosts their net interest margins. So this is like a huge deal for these banks. Like you're really ratcheting up their return on equities. Like it's hundreds of percent. So of increase. So that's a big deal. The other big deal for banks is what kind of protection you have, and that's what you need, because defaults really do, or loan defaults really do undermine their asset base, and they just wreck all the income that they're getting and destroy profitability. So you really want to know that that's a good thing. This week the RBA's came out with a report stress testing the banks basically and saying, yep, they're strong. But the RBA's Philip Lowe also said he's not worried about house prices going down 15%. Well, hello, neither are the banks, because basically they've got loan to value ratios of 80%. So the other thing is, so if it goes down 20%, they don't care. If it goes down more than that, they're okay with it as long as they've got mortgage insurance. So there's a lot of factors in the bank's favour. The other thing is that Australian banks have that, unlike their US counterparts, they have recourse to the mortgagor or lender, who is obliged to pay back the loan whether or not they own the house. That's a big deal. So in the US, basically, in the mortgage market, it's called jingle mail. If the house price goes down, the mortgagor can simply hand back the keys and look for a cheaper house. Like, that's a big difference. That really does give you a lot more confidence in the strength of the asset base of the Australian banks. So I'm not saying there's not risks out there. Clearly, that's the calculation we make as investors. But basically, as the RBA report says, unless we have anything less than a pandemic with no government support, the banks should be all right. After all, the banks are very good at looking after themselves. We all know that. Speaking which, beer. Let's see, what's it called? Nerves of Steel. Mountain Culture in the Blue Mountains. It's a behemoth. My God, it is strong. So what's up for next week? We've got the second part of our oil and gas report. That's exciting, which includes 5 small gas-related stocks. So that's not to be missed. We've also got portfolio management tips coming up, and of course heaps of stock analysis. So it's great to catch up with you again, and I'll catch up with you again soon. Keep safe and bye for now.